Learn how to reduce your overall out-of-pocket costs on college by learning how to save on the cost of college. My name's Monica Felton, and I'm a certified financial planner here in Scottsdale, Arizona. And since 2009, I've been helping families save and pay for college so they don't wreck their retirement. You see, I learned very early in this planning process that traditional financial planning does very little to help families prepare for the crushing costs of college. So I became a college planning expert, a college financial planning expert. So in this webinar, which is about 20 minutes, I'm going to share with you what I've learned. I want you to have the facts. I believe with knowledge and understanding, you'll be able to make well-informed decisions about college saving, college planning, and college funding. I truly believe that this information could potentially save you tens of thousands of dollars on your out-of-pocket costs for college. So let's get started. This is what you're going to learn. What does college cost? There's so much misinformation around college planning that, again, facts are important to help you make great decisions. What is financial aid and how do you get it? Not all financial aid is equal. What are you expected to pay for college? There are formulas that the government has created to determine just what you're expected to pay, common mistakes that cost you money, and lastly, we're going to talk about steps to success. So just how expensive is college? Well, currently an in-state 4-year public diploma costs $120,000. Deep breath. If you're looking to go out of state or those smaller private schools, now a 4-year diploma is about $140,000. And if you're looking at those prestigious private schools, baby Ivies or Ivies, yes, a 4-year diploma is upwards of $380,000. Now, these costs are inflating at 5%, and we actually don't see a slowdown in sight. Now, the challenge is most schools are really struggling to graduate students in 4 years. Only 40% of incoming freshmen actually get their diploma within 4 years. If I do an analysis of ASU, they actually graduate students in 4 years only half the time. And 6 years is 63%. Those are very poor graduation rates. Colorado State, they're 46% of the time they can graduate your students in 4 years, 70% 6 years. And if you are looking at those prestigious schools, they actually do a better job of graduating students in 4 years. USC is 73% for a 4-year diploma and 94% for 6 years. This doesn't always mean a college is bad or terrible, but what it should do is prompt you to ask questions. Why is it that they're only graduating students 53, 46, and 73% of the time? Are the classes not available that their students need? Most of the time, this doesn't have to do with your student. It has to do with their ability to get classes. So ask questions. Usually when families see this type of numbering, they immediately say, oh my gosh, I need financial aid. I can't do this. Well, you need to understand what financial aid is and what it isn't. There's 2 types of financial aid. There's merit-based financial aid, and that's based on your student's academics. And then there's need-based financial aid, which is based on mom and dad's economics. So let's understand the difference between the 2. One thing I do want families to understand are those highly prestigious schools. They do not have any merit money. If you're looking at those baby Ivy, very prestigious schools, they do not offer merit money. All their kids are smart or they wouldn't be getting in. So those schools are only focused on need. But we do have 4,000 four-year universities that would likely love to have your student if they're an academic. So understanding the different schools that are out there will significantly reduce your out-of-pocket costs for college. Now, where do you get financial aid? There's 3 places that you can go: the federal government, the state government, and the college that the student attends. But all financial aid starts with the FAFSA, the Free Application for Federal Student Aid. This is the federal methodology, and there is no cost to complete the FAFSA. Millions of FAFSAs are filed annually, and they're filed October 1st of your student's senior year. Now, the financial information that they're going to use are the tax returns 2 years prior to your student going to college. We call this term prior. There is a very high audit rate on the FAFSA. 35% of FAFSAs do get audited by the school that your student ultimately attends. It's not the IRS, it's the school your student attends. But new for the 24-25 school year is something called the IRS data retrieval tool. This will allow you to populate your FAFSA with your IRS information, and that tool is reducing the amount of audits that schools are actually doing. Again, the FAFSA is available October 1st of your student's senior year, and they're using data prior. So if my child is attending college in 2025, my senior will be able to fill out the FAFSA October 1st of this year, 2024, and they'll be using the tax return from last year, 2023. So you can see when my kid attends college 2 years prior is the tax return information that they're going to use. And data is transferred to the FAFSA using this IRS data retrieval tool. There's also a form called the CSS profile. This is the College Scholarship Service Profile. This is from the institutional methodology, and the CSS profile is required by about 400 schools. These are mostly your private schools with large endowments. So if you're going to tell them you need money, they want you to prove it. There's a more in-depth look into your finances. Again, you'll fill this information out October 1st of your student's senior year, and the CSS profile does have a cost. The cost is $25 for your first submission and $16 thereafter. Now, why is the FAFSA so important? Because the FAFSA is going to give you a number called the Student Aid Index. The Student Aid Index is what a family can expect to pay. It's really the baseline of how much a family should expect to pay for college. You might know this term as expected family contribution, or EFC, but the FAFSA Simplification Act of 2021 recoined or retermed EFC to Student Aid Index. So moving forward, Student Aid Index will be the term that's used to determine what you're expected to pay. There are several factors that determine your Student Aid Index: parents' income and assets, students' income and assets, parents' age, and sadly, the sibling discount has been terminated. So no longer does it matter how many students you have in college at the same time. Here is the basic Student Aid Index formula. It starts with the parents' contribution. The parents, they're going to look at your income, which is equal to your adjusted gross income. Families are allotted an income allowance, and it depends on the size of your family. If you're a family of four, your income protection is $36,000. Now they'll look at your assets. Your assets include everything: stocks, bonds, mutual funds, 529s are considered a parent asset, not a student asset. CDs, cash, real estate, excluding your primary residence. Businesses, if you're self-employed, the value of your business. And farms, values of farms are now required on that FAFSA form. Assets that are excluded are money already in your retirement accounts, like an IRA or a 401k, annuities, and cash value life insurance. Those are excluded. They will also look at students' contribution. Now, if you have a student that works at Starbucks, fantastic. Students also get an income allowance, and it's $9,400. Unless your student is making more than $9,400, income will not come into play. Now, students' assets, a student asset is considered a custodial account, like a UTMA account or a UGMA account. They also look at trusts. A student asset is much heavier assessed in reducing your need-based financial aid. And remember, a 529 is a parent asset and not a student asset. So to give you an example, if I have a family who makes $100,000 a year and they have $100,000 of visible assets and there's no student contribution, in essence, you'll be able to afford about $15,000 to $20,000 a year to pay for college as assessed by your federal government. Yes, $100,000 a year and $100,000 of assets, and you'll be able to pay $15,000 to $20,000 per year per child to pay for college. Debt. Debt is one of the biggest factors families have, and it's a problem because debt is not one of the factors that's used to determine a family's aid eligibility. So that's why working with somebody like me early in the process can be very beneficial, because what we want to do is close the gap between what the government says you can afford to pay and what you can actually afford to pay. In some instances, depending on how you earn your income and where your assets are located, we can actually lower that student aid index or what you're expected to pay. But more of the time, what we're really doing is getting you cash flow efficient. How efficient are you with all that money that's running through your fingertips? Do you have any high interest debt or bad spending habits? We want to make sure to get rid of those prior to your student going to college and then repurpose those found funds into paying for college and maybe even a little into retirement for mom and dad. How is need determined? The first thing they're going to look at is that sticker price, that cost of attendance, and we talked about that earlier. They'll subtract out the student aid index, and that's based on or what you're expected to pay. And that's going to be the amount of financial aid that you're eligible for. Now, the federal government does help. They help with something called Pell Grants. Pell Grants are grants for low-income families whose students have college aspirations. The maximum grant for 2024 is $7,395. Now, the good news about Pell Grants is they don't have to be paid back. So if you have an adjusted gross income of less than $90,000, you could be Pell Grant eligible. That means you don't have any assets either. But again, you're eligible for a Pell Grant. That doesn't necessarily mean you're going to get it. Now, again, where your student ultimately goes to college is usually where the most amount of help comes from. And they can help you in three ways: free money, loans, or do nothing. Now, free money, of course, is our favorite, and they can do this by tuition discounts, grants, scholarships, tuition reduction, and school financial award. Now, remember, I tell my families this all the time: the best financial advice or the best financial thing your students can do for you is study hard and get good grades. Money comes as a way to entice your family to send your academic child to the university. Money is what they use to ask you to come in. If you are not a scholar or they are not interested in your student coming to the school, they're not going to give you free money. So kids, study hard and get good grades. For many families, borrowing for college will be a source of paying for the expense. There are things called federal direct loans. These are from the federal government. They're student loans. Now, student loans, mom and dad, you do not have to qualify for. These are directly with your student. Their freshman year, they can borrow $5,500. Their sophomore year, they can borrow $6,500. Their junior, senior, and possibly fifth year, they can borrow up to $7,500 a year. These loans can be subsidized, which means no interest is accruing while they're in school, or unsubsidized, which means interest is accruing during school. There's also something called a parent loan or parent loan for undergraduate students. Plus, mom and dad, you can borrow right up to the cost of attendance. There is an origination fee of around 4.5% on this money, and they do require repayment 6 months after distribution. Now, you can seek private loans. You can go to your credit union or your bank. You can do a HELOC, a home equity line of credit, or refinance your house as a source of funds. If you have a brokerage account, there's something called a margin account where you can borrow against your stocks and bonds. You could take a 401k loan. You also, if you have cash value life insurance, could borrow against the policy in the form of a policy loan. Now, how much money is available? There's a tool called the Net Price Calculator, and it's available on all the colleges' website. It will help you understand what will your financial award be, the percentage of need met, the percentage of gift versus loans, and please know that every school is different. To show you how different financial aid can be, I wanted to compare two schools. I wanted to look at an expensive school, College A, which is charging $82,000 a year, and College B with a cost of attendance of $35,000 a year. This family has a student aid index of $20,000. That's what they're expected to pay based on the FAFSA. So what will their out-of-pocket costs be? My private school, remember that's the expensive school. My cost of attendance is $82,000. If you subtract out the student aid index of $20,000, now you have your need. At my expensive school, I have need of $62,000. With my affordable school, and I kind of chuckle when I say that, $35,000 affordable. Cost of attendance of $35,000 and a student aid index of $20,000. Please know your student aid index does not change depending on the school you go to. It remains the same. In my affordable school, I also have need, but that need is only $15,000. My expensive school, you see they meet my need 100%, and they're going to do so with 90% gift money and 10% loans. My affordable school is not so generous. They're only going to meet my need 60%, and they're going to do so 10% with gift money and 90% with loans. My expensive school, I have no unmet need. With my affordable school, I do have unmet need. We call that gap, and family, you're required to pay the gap. Now, if I add what I have to pay my student aid index, I have to pay my loans, and I have to pay for any unmet need. If I add all these together, what you see is that my affordable school is actually $34,000 of out-of-pocket I have to spend a year. But my expensive school is only $25,000 per year. Understanding that not all financial aid is the same can go a long way to reducing your out-of-pocket costs for college. Here are the top mistakes that families make when they're planning for college. The first is that they don't fill out the FAFSA. Well, everyone needs to fill out the FAFSA because that is the foundation for all financial aid. It is an important form, and quite frankly, in 12 states, the FAFSA is required. Parents usually don't fill that out because they say, well, you know what? I make too much money, so I'm not going to qualify anyway. And as I mentioned earlier, depending on how you earn your how you earn your income and where your assets are located, sometimes we can change that student aid index and reduce it. There's many unique situations out there: divorce, sale of a business, some large expenses that popped up. So there are some opportunities with the FAFSA if you have a unique situation. Now, many families will pick the wrong schools. There are 4,000 four-year universities in this country, and the top 20% of incoming freshmen at each of these schools get the majority of the aid. They get more money and help. So if you have a smart student with a great GPA and good standardized test scores, they could be eligible for more money depending on school selection. Understanding when a school is a buyer school trying to buy your student or a seller school, they really just don't care, this will significantly impact your out-of-pocket costs. Assuming financial aid is all the same, it is absolutely not, and that's why I shared that example. Financial aid can be free money, but it also can be loans. So understanding how they meet that need is incredibly helpful. Not understanding the formulas. Well, the FAFSA Simplification Act of 2021 changed a 40-year-old system. This was truly an act of Congress. Many things that happened. Number one is they eliminated the student discount. This will be devastating for many families. They now include small business net worth and farms, as well as divorce situations are treated differently. So understanding understanding the changes to that FAFSA, student aid index, etc., will help immensely. And lastly, not getting expert help. If you had a toothache, you'd go to a dentist. If you were sued, you would go to a lawyer. If you got a letter from the IRS, you would contact your CPA. The gargantuan expense of college, you absolutely should seek expert advice to help you create the most efficient plan possible for your family. So again, file the FAFSA, even if you're not a candidate and you feel you won't get aid. As I mentioned, there are now 12 states requiring the FAFSA: Indiana, Oklahoma, Nebraska, Connecticut, Louisiana, Illinois, Alabama, New Hampshire, Kansas, Texas, and California. If you want to go to school in those states, the FAFSA will be required. The other piece is the FAFSA could show the schools that you are able to pay. Schools want full pay families. They want to know that your student will be successful the 4 or 5 years they're in college financially. A lot of schools will look at your FAFSA, see that you're a full pay family, and give you tuition discounts. They want smart students in their school, so they might be willing to give you discounts to entice you to send your student to their college. Many merit-based scholarships do require the FAFSA. Remember, merit is based on your student's academics. And all federal student loans and PLUS loans, those parent loans for undergraduate students, those do require that the FAFSA be sent out. Now, for over 15 years, I've been helping families, and I know what you want. You want happy and successful children. You want them to have a great college experience. You want them to go to the best fit for them. Of course, we all want scholarships and financial aid, and we want to keep our promise. Many of us have been telling our kids if they do well, we'll send them to the college of their choice. not knowing the cost of college could exceed $130,000 for 4 years. And lastly, we all would like to retire one day, so we're really looking for help. A successful college plan, you really need to understand these 4 things. What are you expected to pay? What role will financial aid play in your college funding plan? Are you on track for retirement? College planning is financial planning. And lastly, what's the best strategy to pay for college? What are your next steps? Well, I want you to get the facts and specific to you. If you head over to my website, monicafelton.com/college, you could obtain a free personalized college funding report. You'll need to enter some data, your student's SAT, ACT, or ACT, and GPA, and you can guess if you want or estimate. You'll need to put in mom and dad's assets, mom and dad's income, student's assets, student income, and choose the school that their student is most interested in. From there, you're going to get this report that's sent to you. Now, for my purposes, I chose the school Cal Poly San Luis Obispo, because that's where my daughter's at school. So the financial aid data will be specific to the school that I put in to the calculator. You'll see that there's a 4-year to 6-year graduation rate of 51 to 82%. The current 1-year cost of attendance is $39,000. And again, that includes tuition, fees, room and board, books and supplies, personal expenses, and travel. And current room and board cost is $17,220. You will also see what financial aid forms your school of choice requires. So Cal Poly only requires the FAFSA. They will tell you how much need they're going to meet. If I have $10,000 worth of need, they're only going to meet 67% or $6,700. Of that $6,700, they'll give me 75% gift money and 25% self-help. Remember, self-help I have to cover. Now, this is what's most important, is helping families understand what they'll be expected to pay. You cannot wait until your student's senior year to understand what you're expected to pay. Now you understand the formulas that are required to determine your aid eligibility. You now know what your student aid index is going to be. And if you go and fill out this calculator, you will have the first 2 steps of a successful college funding plan completed. What you're expected to pay and what role will financial aid play. Again, I've had the blessing of helping so many families with this process over the last 15 years. I want you to make well-educated decisions so that you save on the cost of college. If there's anything I can do to help you, please don't hesitate to reach out to me. I welcome the opportunity to chat with you. Please go on and get your personalized college planning report, because again, that will give you the information that you need to start a successful plan on paying for college. Families ask me all the time, Monica, when's the best time for me to start paying for college or planning for college? And I say the best time to plan was when your student was in the womb, and the next best time is today. Thank you so much, and I wish you only the best on your paying for college plan. Take care.